Good evening, students. So today what we are going to start with is the revision and under section 263 and under section 264. If you remember, we had done the appeals entirely in the last class. Now we are left with the revision portion and we'll start with it, and then we'll finally start with the penalties topic. Okay. So let's get quickly started with the revision. First is revision under section 263. So see, where were we exactly? Here. So once the assessment order is passed, then in that particular case, what happens is we have the option of first the rectification. Rectification under 154, revision under section 264, appeal under section 246A, or we can go for the dispute resolution committee, or if it's a transfer pricing case, we can go to dispute resolution panel. In that case, we have to first object to the draft order itself before the final order is passed. Okay. Now, in case we go for revision under 154, then it should be the mistake apparent from record. For appeal to the CITA, as I was telling you that it's a normal case, right? And if it's a small case where the demand is less than 10 lakh, where the total income is less than 50 lakh, then you can go for dispute resolution committee, even if it's a transfer pricing case, right? Or you go for DRP. Right? Now, DRP, as I said, you have to go for the draft order, you have to object it, and then as per the DRP direction, the final order will be passed. Now, the DRP directions after which the final order is passed, that can be directly appealed to the ITAT. Okay. And from there, we have the High Court and Supreme Court. Okay. Again, for DRC, it's the same thing that cannot be appealed. DRC order cannot be appealed at any level once it is passed. Okay. In the DRC, what we had seen was, in the DRC, we had seen that the DRC will first take a call whether to accept or reject the case, right? And the show cause notice will be issued for that. The assessee will file the response, and then based on that, the DRC may admit or reject the application. Then the assessee has to also give the proof that he has withdrawn the appeal, and then the DRC will call for the information. Based on the information and material on record, the DRC will make the modifications to the variations made in the order by reducing the variations, or it may not make any modification but can waive penalty and immunity from prosecution. It will pass the order within 6 months, and once it passes the order, the assessee has to comply with payment of taxes. Once taxes are paid, only then the waiver of penalty or immunity from prosecution can be granted. Are we clear? Are we clear? Clear? Yes. Okay. Now, the next alternative was the revision. But first, before we go for revision under section 264, we have the revision under section 263 as well. So let's talk about first the revision under section 263. Revision under section 263. Now, revision under 263 can be done if the revision of order is prejudicial to the revenue. If the order is prejudicial to the revenue, then the revision under section 263 can be done. So, order prejudicial to the revenue, right? So if the order is prejudicial to the revenue, then the revenue can revise the order. So if the principal commissioner or principal chief commissioner or CCIT or CIT considers that an order passed by the AO is erroneous, and prejudicial to the interest of revenue. He has the power to pass an order enhancing or modifying the assessment made by the AO or cancelling the assessment and directing the fresh assessment. So he has the power that the order which is passed by the AO, he can enhance the assessment or he can cancel the assessment and direct the new assessment to be made. But before he does all of this, he has to give the opportunity of being heard to the assessee. He has to give the opportunity of being heard to assessee. So he can enhance the assessment. He can modify it. Or he can cancel it and direct for fresh assessment. But he has to grant the opportunity of being heard to assessing. Right? Now, when is the order considered that it is erroneous and prejudicial to the interest of the revenue? If in the opinion of PCCIT or CCIT or PCIT or CIT, the order is passed without making inquiries or verification. Without making inquiries or verification. Right? Or the order is passed allowing any relief without inquiring into the claim. So if the order is passed without making inquiries or verification, or if the order is passed allowing any relief without inquiring into the claim. Order is passed allowing the relief without inquiring the claim. Or the order is not in accordance with the direction or instruction of the CBDT. Not in accordance with direction or instruction of CBDT. Or the order is passed which is not in accordance with the decision of the High Court or Supreme Court. So an order has not been passed in accordance with any decision which is against the or which is in the favor of the revenue, which is rendered by the jurisdictional High Court or Supreme Court, either in the case of assessee or any other person. So order is not in accordance with jurisdictional High Court or Supreme Court ruling in favor of revenue. Okay. So the Principal Chief Commissioner CCIT or PCIT or CIT, if they are of the opinion that the order passed by the AO is erroneous insofar as it is prejudicial to the interest of revenue. And what is erroneous or prejudicial to the interest of revenue? if the order is passed without making inquiries or verification, if the order is passed which is allowing any relief, which is without inquiring into the claim, order which is passed which is not in accordance with the directions of the CBDT, or the order if it is not in accordance with the decision of the jurisdictional High Court or Supreme Court. Then, in that case, after giving the opportunity of being heard to the assessee, the PCCIT or CIT or CCIT or PCIT can direct for the revision of the assessment. And they can, in that case, enhance the assessment, modify the assessment, or cancel the assessment and direct the fresh assessment. Now, if the PCCIT is of the opinion, now how they would form that opinion that the order is erroneous insofar it is prejudicial to the interest of the revenue. How would they form this opinion? So they would form this opinion based on the material available on record. They will form this opinion based on the material which is available on record. And the record means the records relating to the assessment proceedings which are available at the time of examination by the Principal Chief Commissioner or Chief Commissioner or PCIT or CIT. Right? So in that particular case, they will come to this opinion based on the record which is available before the PCCIT or CIT, whatever. Right? Now, in this particular context, there is one particular decision what we have to consider over here. And what is that decision? Let's try and understand. So, in one of the case, the question before the High Court was that can the revisionary proceedings can be exercised? Can the revisionary proceedings be exercised based on the material which is not there? So that is not possible. So the material which is there before the Principal Chief Commissioner, based on that, he has to decide whether the order is prejudicial to the interest of revenue or it is erroneous. It is erroneous insofar as it is prejudicial to the interest of revenue. Are we clear? So it has to be based on the material which is available on record. So let's say, for example, if the Commissioner of Income Tax issued the notice to revise the order passed by the AO, now during the pendency of the proceedings before the Commissioner, he had some material gathered during survey. There was some survey conducted after the issue of the notice. So he issued the notice under 263 to revise the order passed by the AO, and later on some survey was conducted under 133A. And then the Commissioner issued a second notice, the contents of which were different from the first notice. Can he do so? So the action of the CIT is not justified. Why? Because the record will include always the records which are there available at the time of examination by the Commissioner. So information, material, reports which were not in existence at the time of assessment and which came into existence later on. So the materials which were not in existence at the time of assessment and came into existence afterwards can be taken into consideration by the CIT for the purpose of initiating 263. But if you see, that material has to form part of the record when the action under section 263 is taken. So the material should be there which should, on the basis of the record which is available at the time of examination by the PCCIT, based on which he is concluding that the order is prejudicial or erroneous and prejudicial to that of the revenue, interest of the revenue. In this case, he has issued the notice under section 263. And then he issued the second notice based on the survey which was conducted, which was totally unrelated to the first notice. So the second notice which is issued, the material on the basis of which the second notice was issued cannot be said to be record available at the time of examination. When he was considering the first notice, whether at that time the survey material was available, the answer is no. So then in that case, he cannot issue then the notice based on the material which was not available at the time when he was examining the particular order. Are we clear? Okay. Now, one more thing over here is, if you remember, we had spoke about the doctrine of partial merger and total merger. Doctrine of partial merger and total merger, if you remember this. So, where did we speak about this? You remember this? Where did we talk about this before? Where did we speak about this before? Where I spoke to you about doctrine of partial and total merger. Quickly tell me. Where can you recollect? Yes. Where can you recollect? Yes, correct, Kaushiki. Yes, Dilip. 263, 264. 264 is total, 154 and 263 is partial. Yes, correct. So, now we are talking about 263. We had spoken about the doctrine of partial merger while we were dealing with 154. Let's say, for example, if with respect to issue A, I have gone to CITA, and with respect to issue D and C, I'm going for rectification under 154. Is that possible? The answer is yes. For issue A, I cannot go for rectification because of the doctrine of partial merger, that the order with respect to that issue merges with the order of the higher authority, right? In case of 263 as well, the doctrine of partial merger is applicable. So where any order which is passed by the AO has been subject matter of appeal, then the PCCIT or CCIT cannot consider that for revision. The powers of the PCCIT or CCIT or PCIT or CIT will not cover the revision in respect of those matters. Are we clear? So you can write it over here. Doctrine of partial merger. That is, if on any issue appeal is pending before CITA, revision under section 263 cannot be exercised. Are we clear? Now, what is the time limit of revision? What is the time limit of revision? Time limit is 2 years from the financial year in which the order was passed. So time limit is 2 years from the financial year in which order was passed. Are we clear? So this is about 263. Now against the order of 263, what you can do once the order in the section 263 is passed, you can go for IT-80. So even the order of, you can write it in the IT-80 appeal under the appealable orders. Order of PCCIT or CCIT or PCIT or CIT under section 263 can be appealed before the IT-80. So the order under section 263 can be appealed before the IT-80. Clear? Are we clear? Okay. Next is, so this is the opportunity which is given to the income tax revenue officer to revise the order if it is erroneous insofar as it is prejudicial to the interest of the revenue. So this is the opportunity to the income tax department to revise the order. In case the assessee is aggrieved with the order of the AO, then as I said, you have rectification under 154, you have CIT appeals, you have dispute resolution committee, and you have revision under section 264. Now revision under section 264. In case of revision under section 264, when it can be done? So in case of any order, right, which is passed by the AO, the principal chief commissioner or CCIT or PCIT or CIT, either on the application made by the assessee or suo motu, may undertake the revision under section 264. So this can be done suo motu or on the application filed by the assessee. Now, what is the time limit to revise the order under section 264? Under section 264, the assessee has to make the application within the period of 1 year. So 1 year from the date on which time limit to make application, 1 year from the date on which the order is communicated to assessee. Order is communicated to assessee. Are we clear? And if it is suo motu, then also 1 year from the date of the order. Clear? But the PCCIT or CCIT can condone the delay if the sufficient cause is produced. Clear? So delay can be condoned based on sufficient reason. Are we clear? Now, here the doctrine of total merger applies. Here the doctrine of total merger is applicable. Meaning, if I have gone for appeal for issue A For issue B and C also, I cannot go for revision under section 264. So in this case, the doctrine of total merger is applicable. Are we clear? So here, if I have gone for issue A to CIT appeal, I cannot even go for revision under section 264 for issue B and issue C. Further, the principal chief commissioner or chief commissioner is not empowered to revise any order where the appeal is pending before the CITA or the ITA. Or even if the appeal is not pending, but the time limit for which the appeal can be made has not expired, and the assessee has not waived his right of appeal. So even if the appeal is not pending, but the time limit for appeal has not expired and the assessee has not waived his right of appeal. So before the assessee comes under section 264, he has to waive his right of appeal. Okay. So doctrine of total merger is applicable. No revision under section 264 if order is subject matter of appeal or time limit for appeal has not expired and assessee has not waived his right of appeal. Are we clear? Clear? So the PCCIT or CCIT can pass the order again in this case within a period of 1 year from the end of the financial year in which application is made by the assessee for revision. What is the time limit to pass the order? 1 year from the financial year in which application is received. Are we clear? Any doubt? Any question? Any doubt? Any doubts? Okay. So this is 263 and 264. Again, 263 and 264 is conducted in a faceless manner. Okay, so 263 and 264 is also conducted in a faceless manner. Clear? Any doubt till now? Yes. CITA under 246A is also total merger. No. Kaushiki, the total merger doctrine does not apply to CITA. Because you are going to CITA, you're only going to CITA. You're not going in other forums, right? But if you're going for rectification, you can go for CITA as well as the rectification. Sufficient reasons, Kaushiki, can be maybe due to some health issue, maybe some genuine reason for which the assessee was not able to make the application, financial reasons. So maybe because of that, or maybe because of the health issues, they have not been able to make. So that could be the sufficient reason. Clear? Okay. Now one more case with regard to the doctrine of total merger which is there. So this is regarding the 263. Can the commissioner invoke the revisionary jurisdiction under section 263 when the subject matter of revision has been decided by the CITA and is pending before the tribunal? So in that particular case, the order of the first appellate authority, which is CITA, is passed. The order of the CITA has been passed and the appeal is now pending before the tribunal. So in that particular case, the CIT cannot invoke the 263 for the same issue which has been decided by the CIT, because the order passed by the AO gets merged with the order of the CIT. Clear? So that is just a simple case which was there in the module. So I covered it. Okay. Now last one thing. With regard to, as I said, 264, either, as I said, you can go for 154, you can go for 264, you can go for CIT appeal or dispute resolution committee. Clear? Any questions, any doubts so far before we proceed further? Clear? Yes or no? Okay. Now, last one thing is regarding the monetary limit. Which is there. So, this is in relation to the monetary limits which are there for the appeal to be admitted. Now, what is this? So, in case of the appeals by the department before the ITAT, High Court and the Supreme Court, there are certain monetary limits which are applicable. If the tax effect does not exceed these monetary limits, then the appeal cannot be filed. Are we clear? So what are these monetary limits? Yes. So you can write it over here after the High Court, Supreme Court, right? Appeal. Monetary limit for department appeal. This is not for assessee, this is for the department. When the department is appealing. For the ITAT, it is rupees 50 lakh. For High Court, this is 1 CR. And for Supreme Court, this is rupees 2 CR. Okay. So the tax effect should be less than or should be more than this. Tax effect should be greater than this. Right? So what is the tax effect? Tax effect is basically the tax on the total income assessed minus the tax that would have been chargeable had the total income would have not considered those additions which are made, right, against which the appeal is being filed. So the tax effect is basically the tax on the assessed income, which the AO's order consists, minus the income on which, minus the tax on the income without considering the disputed issues. So in effect, it is the tax on the disputed issues, right? If that is exceeding this amounts, only then you can file the appeal. Are we clear? So these are the monetary limits which are there, and these does not apply to the writ matters. In respect of the writ petitions filed, these cannot be considered, or where there is constitutional validity is under challenge, or where the CBDT's order is held to be illegal or ultra virus, where the addition relates to undisclosed foreign income or undisclosed foreign assets, or where the prosecution has been filed by department. In all these cases, the monetary limits are not applicable. Clear? Any doubt? Okay, so you can just write down. These are not applicable in constitutional cases. Then CBDT circular or notification held as ultra virus, addition in relation to undisclosed foreign income or assets, prosecution, then writ petition, bogus LTCG or STCG, to penny stock, the registration of trust, right? In these cases, the monetary limits will not be applicable. So even if it is less than 50 lakh, the appeal can still be filed. Okay. Any questions so far? Okay. So this is what we are completing our appeals and revision topic. Now the next topic is penalties. Next topic is penalties. So let's get quickly started. Now with respect to the penalties, we will first focus on the important or the penalties which are very, very elaborate. And then we'll focus on very small penalties, because some of the penalties, if you remember, we have already done with the relevant section as well. So here we will be focusing first on the penalty which is in relation to the underreporting and misreporting of income. So first, penalty for underreporting of income under section 270A. Okay. Now 270A is penalty for underreporting of income. Now, who are the authorities who are empowered to initiate the penalty under section 270A? Assessing officer, the CIT appeals, the principal commissioner, or commissioner of income tax. So AO, CITA, or TCIT, or CIT. Now, what do we mean by underreporting of income? So, if my return of income has been filed, if my ITR is filed, then in that particular case, what will be my underreporting of income? If my income which is assessed, is greater than income which is determined under section 143(1), which is the intimation. If my income which is assessed by the AO, is greater than, let's say this I call it as A and this is B, is greater than the income which is determined under 143(1), when the summary assessment is made. Where, say for example, return of income is not filed, or it is filed in response to notice issued under section 148. So if the reassessment happens, notice is issued under 148 to file the return of income, right? So if it is not filed, you will file the return of income in response to 148. Then in that particular case, the income assessed, if it is greater than the basic exemption limit. What are we discussing over here? When is underreporting of income considered? If my income assessed is greater than the income determined under 143(1), if the return is filed. If the IDR is not filed, then income assessed is greater than basic exemption limit. In case it is a reassessment, in case of reassessment, if my income reassessed is greater than income assessed before such reassessment. So income assessed before such reassessment. Are we clear? So in these cases, there will be underreporting of income. Now, if return of income is filed and assessment is based on AMT or MAT provision. This is for the normal provision. If the ROI is filed and assessment is based on MAT or AMT provision, then deemed total income assessed as per 115 JB or JC, deemed total income, or which will be your book profits only, assessed as per 115 JB or JC. For JC, it is adjusted total income. And if it is greater than the deemed total income determined under 143(1). Determined under section 143(1). If no return of income is filed or filed in response to 148 and assessment or reassessment is based on MAT or AMT. No return of income is filed and or filed in response to 148 and assessment or reassessment is based on MAT or AMT. Then again the same thing, deemed total income under section 115 JB or JC, assessed under section 115 JB or JC, and for the individuals, you can consider your basic exemption limit. For individual HUF, AOP and BOI. For MAT, of course, it will be company. So basic exemption limit is not a question. Okay. Last one. If there is reassessment as per (115 JB or JC), then deemed income, deemed total income reassessed as per 115 JB or JC, and deemed total income assessed prior to reassessment as per 115 JB or JC. Are we clear? Clear? Any doubt? So if I have the ITR is filed if my income assessed is greater than income determined in the 143(1). If it is a normal case, if it is MAT or AMT case, then deemed total income under section 115 JB or JC, which is assessed, if it is greater than deemed total income determined under 143(1). If the ITR is not filed or filed in response to 148, if income assessed is greater than basic exemption limit. Same for MAT. If the deemed total income which is assessed is greater than the basic exemption limit is only applicable for AMT provision. If it is a case of reassessment, then income reassessed if it is greater than the income assessed in the original assessment. Same is for 115 JB case, that deemed total income reassessed as per MAT if it is greater than the deemed total income as per 115 JB JC, which was assessed in the normal scrutiny. Are we clear? Then, in case of loss, if it is a loss case, then if the loss is reducing or converting the loss into the income, if the income which is assessed or reassessed has the effect of reducing the loss or converting the loss into income. Loss is reduced or loss converted to income. Clear? So then one can say that there is underreporting of income. Clear? Now, if there is underreporting of income, what is the penalty? Penalty for underreporting is 50% of the tax on the underreported income. 50% of tax payable on underreported income. In case of misreporting, the penalty is 200% of tax payable on underreported income due to misreporting. Now, what is misreporting? What is misreporting? Let's try and understand. Where there is misrepresentation or suppression of facts. Misrepresentation or suppression of facts. Say, for example, I have claimed some deductions which I was not allowed to claim. I have misreported the facts, or I have suppressed the facts. Even during the assessment, I have not shown my some second business, or I have shown the lower profits than what I was supposed to show. I have misrepresented or suppressed the facts. I have done the tax evasion. Failure to record investments in books of accounts. Investments in books of accounts. Claim of expenditure not substantiated by evidence. Not substantiated by evidence. Recording of any false entry in the books of account. Recording false entry in books of accounts. Failure to record any receipt in the books of accounts. Any receipt in books of account which has bearing on total income. And finally, failure to report any international transaction or deemed international transaction or specified domestic transaction. We will learn what is international, deemed international, and specified domestic transaction in the transfer pricing chapter. Okay. Failure to report. For now, you can just write it down. Any international transaction or deemed international transaction or specified domestic transaction. Okay. All these cases will be considered as the misreporting of income. Clear? Now, how do we calculate, first of all, the underreported income? How do we calculate that? What is the underreported income? First, you have seen that, okay, there is underreporting of income. But how do you calculate the underreporting of income? So it's very simple. It's based on this only. So this is underreporting of income, right? The calculation is also based on this logic only. Calculation of underreported income. So where the income tax return has been filed, where the income tax return has been filed, where the return is furnished and the assessment is made, then it's same. Assessed income minus income determined under section 143(1). So assessed income minus income determined, that is my simple underreported income. Where the return is not furnished or where the return has been furnished in response to 148, then for the companies or partnership firm, for the companies, partnership firm or local authority, it is assessed income. For the individuals, HUF, AOP, BOI, it is assessed income minus basic exemption limit. Clear? Where it is reassessment, then in that particular case, the income reassessed minus the income assessed in the first assessment. Income assessed earlier. Where it is arising out of the deemed total income computed in accordance with 115 JB or JC. So for all of these cases, it is in the same way. This is A minus B plus C minus D. A is my total income assessed as per the general provisions. Let me make it like this. A minus B plus C minus C. A is the income as per general or normal provisions. Income assessed as per the normal provision. Total income. Okay. B is the total income that would have been chargeable had the total income assessed as per the general provisions been reduced by the amount of underreported income. So B is without considering the underreported income, what is the total income which would have been chargeable as per the normal provision. So B is total income without considering underreported income as per general provision. So A minus B will in effect give you the underreported income as per normal provision, right? Then your C is the total income which is assessed as per the MAT or AMT. C is total income as per MAT or AMT. And D is the total income without considering underreported income as per MAT or AMT. Yeah. So this will give you underreported income as per AMT or MAT. Are we clear? Any doubt till now? Okay. Then in case of loss, it will be the loss claimed minus the income or loss assessed. Fine. This will give you the underreported income. Okay. This will give you the underreported income. The calculation of underreported income is clear. Any doubts? Any questions so far? Any doubt? Any questions? Is it clear till now? Yes or no? Okay. Yes or no? Okay. Now, how do we calculate the tax on the underreported income? So, tax on underreported income. How do we calculate the tax? So tax on underreported income, where no return of income is filed. Or let me just put it here only so that you have the link, everything here only. This was the calculation. This is tax on underreported income, where return of income is filed and total income is determined under section 143(1) or under assessment or reassessment, right? Where the return of income is filed and the total income is determined under 143(1) or this particular case. So where the return of income is filed and total income is determined under section 143(1), that is summary assessment, or 143(3) normal assessment, or under 147 reassessment, right? Then the tax payable in respect of the underreported income shall be the tax on the underreported income. Tax on the underreported income. So tax on the underreported income as if it was the total income. As if it was the total income. Are we clear? So tax on the underreported income as if it was the total income. Are we clear? So where the return of income is filed and the total income is determined under 143(1) or 143(3) or 147, then the tax on the underreported income plus total income, which is assessed under section 143(1) or 143(3) or 147, minus the tax on the total income determined under section 143(1), 143(3) or 147. In effect, it is tax on the underreported income. Tax on the underreported income means as if it's a total income. Total income. Where no return of income is filed. Where no return of income is filed, then in that particular case, or it is filed in response to 148, then notice under section 148, then it will be the tax on the underreported income as increased by the basic exemption limit. So tax on underreported income plus basic exemption limit. Okay, tax on the underreported income plus the basic exemption limit. And in case of loss, which is this case, it will be tax on the underreported income. Tax on the underreported income. Okay. So if it is the return of income is filed under section 143(3) or under and this the total income is determined under 143(3), 143(1) or 147, then in that particular case, tax on the underreported income as if it's a total income. But how will you do it? So the way to do it is that the amount of tax calculated on the underreported income, the presentation will be in this manner. So tax on underreported income plus total income assessed as per 143.1, 143.3 or 147 minus tax on total income assessed under section 143.1, 143.3 or 147. Fine. Is it clear? Any doubt? Any questions? Okay. Now, what will not be considered as underreported income? So, you can just write it here. Cases not included within scope of underreported income under section 270A, where the assessee offers the explanation and the AO or CIT appeals or PCIT is satisfied that the explanation is bona fide and all the material facts have been disclosed to substantiate the explanation. So where the assessee is offering the explanation to the satisfaction of the AO or the CITA, and he is satisfied that the explanation is bona fide and all the material facts have been disclosed, then it will not be covered under section 270A. Okay. Where the assessee offers the explanation and the AO or CIT appeal, PCIT or CIT is satisfied that the explanation is bona fide and all the material facts have been disclosed. All the material facts have been disclosed to substantiate the explanation. Fine. Where the underreported income was determined on the basis of the estimates. So, if the income tax authority feels that the accounts are correct and complete, but the income is determined on the estimate basis, then in that case, this will not be under the scope of the underreported income, where the income determined on the basis of estimates. So in some of the businesses, it's not very, clear how to calculate the income because of the nature of business. Let's say kirana store or grocery shop, right? They usually determine the income on the estimate basis because they are not maintaining the books of accounts and all of that very particularly. But yes, here the books of accounts are complete and correct, but the income is determined still on the estimate basis. Then it will not be considered in the scope of the underreported income. Or the income is determined on the basis of the estimate if the assessee has on his own estimated a lower amount of addition or disallowance and has included such amount in the computation of income. So assessee himself has disallowed some amount and included, then it will not be considered as underreported income. The amount of underreported income which is represented by the addition made in the arm's length price determined by the TPO. So, where the addition is on account of arm's length price determined by the transfer pricing officer. And the assessee has maintained all the information documents which are prescribed for the transfer pricing purpose and has disclosed all the material facts. See, what happens is the calculation of the arm's length price is very, very subjective. You will see it when we do the transfer pricing class, right? So in that particular case, it's very subjective. How the assessee calculates the transfer pricing arm's length price may be different from how the transfer pricing officer will calculate. So there is bound to be the subjectivity, there is bound to be discrepancy between the both. And considering that as underreporting of income is not correct. So therefore, that has been clearly put outside the purview of the underreported income. The amount of undisclosed income is on account of search operation. Undisclosed income is on account of search operation, because for this the penalty is leviable under 271 AAB. So again, the penalty under section 278 cannot be imposed. Are we clear? So where the income is based on estimates or where the assessee offers sufficient explanation to the satisfaction of the AO, where it's a transfer pricing adjustment made by the transfer pricing officer, or if the undisclosed income is on account of search operation, then it cannot be considered as the underreported income. Are we clear? Where ROI is filed, Kaushiki, tax will be also on basic exemption limit. Where the ROI is filed, tax will be also on the basic exemption limit? No. If the ROI is not filed, then you have to add the basic exemption limit. Clear? Any doubt? Okay. Any questions other than this? Any doubt, any questions? Okay. Now, in this particular case, understand one thing. The PCIT or the CIT has a power to reduce or waive penalty in these cases, which is imposed under 270A. If prior to the detection by the AO, the person has voluntarily and in good faith made the full and true disclosures of the particulars of income. That is where the excess of income is assessed over the income which is offered by him, is of such nature as to not attract the penal provisions under 270A. So in that particular case, the PCIT or CIT has the power to grant the immunity from the penalty under section 270A. Are we clear? So in that case, the PCIT or CIT can offer the immunity from the penalty or can grant the reduction or waiver of the penalty under section 270A. So you can write it here. PCIT or CIT can grant reduction or waiver of penalty if prior to the detection by the AO, the person has voluntarily and in good faith made full and true particulars disclosures of income, right? Of income, or you can write of excess income. So this is the reduction or waiver of penalty. Okay. So in this particular case, the waiver can be granted or reduction can be granted. Now, one more important aspect over here, which is the immunity from the penalty under section 270A. Now, what is the immunity? This was the reduction or waiver of penalty, right? So, under section 273A, you can write down this is section 273A. Under this section, the principal commissioner or commissioner of income tax has the power to reduce or waive the penalty which is imposed under 270A. And what are the conditions to be satisfied? The assessee should have made full and true disclosures of the excess income, and that too prior to the concealment of the prior to the detection of the concealment by the AO. Are we clear? So in this case, before the AO has detected the concealment of income, the assessee has made the full and true disclosure of the income, and in voluntarily and in good faith. Are we clear? Then he has cooperated in inquiry. He has cooperated in the inquiry relating to the assessment. He has paid the tax or interest. He has paid the tax or interest which is payable. And this relief which is there is available only once in a lifetime. So where an order is being made under 273A, in this particular case, the assessee can claim this particular waiver or reduction of penalty only once in the lifetime. He will not be entitled to claim this relief for any other assessment year. So this is once in a lifetime relief which is granted. Are we clear? And the order of the principal commissioner or CIT under 273A is final and cannot be challenged in any court or before any authority. So the order of PCIT or CIT is final and cannot be challenged in any court. This is the final order. Okay. And the order accepting or rejecting the application has to be passed within a period of 12 months from the end of the month in which application is made or is received by the PCIT or CIT. Are we clear? Any doubt? Okay. So, order accepting or rejecting the application time limit is 12 months from end of the month in which application is received. Okay. Are we clear? Then this is about the power of the PCIT or CIT to reduce or waive the penalty. There is also power which is there for the immunity from the penalty altogether. And what is that? So, immunity from the imposition of penalty can be granted immunity from penalty. This is under section 270 AA. The assessee has to make the application to the AO for grant of immunity from imposition of penalty under 270A. If the assessee pays the tax and interest as per the assessment order and does not prefer any appeal against such assessment or reassessment order. So, assessee to make application to AO, pays tax and interest on, pays tax and interest on the income determined in assessment order and does not appeal against the assessment order. Are we clear? Assessee has to make this application within 1 month from the end of the month in which the assessment order is received. Within 1 month from the receipt of assessment order. Are we clear? Then the AO can pass the order accepting or rejecting the application for immunity from penalty within a period of 1 month from the end of the month in which application is received. However, if he is rejecting the application, he has to grant the opportunity of being heard to the assessee. So, AOT pass order accepting or rejecting application within 1 month from end of month in which application is received. Are we clear? This order will be final order. Just like the waiver or reduction order which is there, even this order of the AO is final order and no appeal or revision application is admissible against the order of assessment or reassessment which is made for the application for the immunity from penalty. So then if this order is passed, you can then cannot appeal also against the assessment order because you have withdrawn the right of appeal. Are we clear? So the order of the AO is final and no appeal or revision can be filed. Are we clear? Okay. Are we clear? So no appeal under 246A or revision shall be admissible against the order of the assessment or reassessment in a case where the order has been made accepting the application. If the application is accepted, then you cannot make the assessment, then you cannot do the appeal. Yes, if it is rejected, then you can go for the CIT appeal within 30 days of the notice of demand in the same manner what we had seen for the CIT appeal. Okay. Are we clear? Any doubt till now? Okay. Now, last one thing under the penalty under section 270A, which is there. So, the penalty order is to be separately passed. The penalty order is to be separately passed. Okay. And for that again, the assessee shall be granted the opportunity of being heard. Okay, the assessee will be also granted the opportunity of being heard. Now, what is the time limit for passing the orders which are there for the penalty? Where the assessment order is the subject matter of appeal, then in that case, the order imposing the penalty shall be passed before the expiry of the financial year in which the proceedings, in the course of which the penalty is initiated. So before the expiry of the financial year in the proceedings in which the appeal is initiated, or within 1 year from the end of the financial year in which the order of the CITA is received by the PCCIT. Are we clear? So you can just write down. You can write it here. Time limit for passing penalty order. Time limit for passing the penalty order. So where the order is subject matter of appeal, before the CITA, then in that case, later of, before the expiry of financial year, before the expiry of financial year in which the proceedings are completed. And or within 1 year from the end of the financial year, from end of the financial year in which order of CITA is received, PCCIT or CCIT, or PCIT or CIT. Okay. Where the order is subject matter of revision under 263 or 264. Order is subject matter of revision under section 263 or 264. 6 months from the end of the month in which revision order is passed. And in any other case, let's say it's a case of assessment, then after the expiry of the financial year, later of expiry of financial year in which proceedings are completed, or 6 months from the end of the month in which penalty is initiated. Are we clear? Okay. Any doubt? Okay. Any question, any doubt? Fine. So this is the time limit for the penalty order. This is the time limit for the penalty order, right? Now, can the penalty order be appealed before the CITA or before the tribunal? The answer to that is yes, it can be. So the penalty order is also appealable, right? The penalty order is also appealable. Fine. Any doubt? Fine. Clear? Okay. Now, let's take a small break of 10 minutes and then we get back. Okay. Let's take a small break of 10 minutes. So students, last one thing in these kind of penalty under section 270A, which is there for underreporting or misreporting, I would also like to cover here the prosecution part, which is in relation to this. So prosecution means that the imprisonment which could be there, right? So in case there is willful attempt to evade tax, penalty or interest, right? Or underreporting of income, then there is prosecution under section 276C, which is the evaded amount or tax on underreported income if the evaded amount or tax on underreported income, if it is greater than rupees 25 lakh, then it's 6 months to 7 years plus the fine. And in other cases, it is 3 months to 2 years. Plus fine. Okay. So this is for willful attempt to evade tax, penalty or interest or underreporting of income. Are we clear? So this is the prosecution under section 276C. Now prosecution will not be initiated in case there is the waiver granted for the penalty also. Okay. In case where the waiver is granted. Okay. Now we'll solve some questions on the underreporting of income. So from your module itself, we'll solve some questions. I'll just quickly share your module. Okay. Illustration 3. ABC Limited is a domestic company liable to 25% tax. Following are the particulars. As per the return of income furnished under 139(1), there was a loss of 15 lakh. Determined under 143(1)(a), it is 8 lakh loss. Assessed under 143(3), it is 5 lakh loss. And reassessed under 147, it's a 4 lakh income. Is penalty leviable under 270A? And if so, what is the quantum? So solve this question and let me know the answers. Yes, Jacob, even if they do not pass that within the time limit, the order will get invalid. Jacob, if the assessee doesn't have money to pay penalty, then the recovery proceedings will start. Let me zoom it. Okay. Yes. Give me the answers for question 3. What is the answer? Yes, Kaushiki, penalty is leviable. What is the penalty amount? No, the penalty amount is incorrect. Yes. Okay, let's solve together. So the loss assessed under section 143(3) is 5 lakh and the loss determined under 143(1)(a) is 8 lakh. So clearly there is underreporting of income because it's leading to reduction of the loss. Now what is the underreporting of income? 5 lakh minus 8 lakh, which is 5 lakh plus 8 lakh, right? So that will be 3 lakh. Minus 5 lakh plus 8 lakh is 3 lakh is the underreported income. Tax on the underreported income is 25%. And with that, education cess, so that comes to 78,000. Right? 78,000. And 50% of that, the penalty would be 39,000. Clear? In the second case, it is reassessment under 147. 4 lakh is the income. So loss is getting converted to income. Again, there is underreporting. So minus 5 lakh and minus 4 lakh. So that will come to 9 lakh rupees. So minus 5 lakh minus 4 lakh. 4 lakh is positive, right? So 9 lakh, and then on that 25% is the tax, 4% is the education cess. So 2,34,000 and penalty on that is 50%. So if you can see the answer over here. Are we clear? Clear? So 1,17,000 in the case of reassessment and 39,000 in the case of assessment. Illustration 2. Mr. Ram, a resident individual of the age 55 years, has not furnished his return for AY 22-23. However, the total income assessed in respect of such year under 144 is 12 lakh. Is penalty under section 278 attracted? And if so, what is the quantum of penalty? Yes. So tell me the answer. Jacob, which 15 lakh you are saying? No, 15 lakh you don't need to consider because you have to determine as per the 143(1)(a) and the income assessed under 143(3) and 147 then. Clear? What is the answer quickly? No, Kaushiki, that's not the correct answer. Yes. So in this case, you need to consider the total income assessed under 144, which is 12 lakh, right? Minus the basic exemption limit. So in this case, there is underreporting of income, right? So total income under 144, 12 lakh minus 2 lakh 50, basic exemption limit 9 lakh 50, right? Now tax payable on the underreported income, which is in this case, and which is what total income on the underreported income is 9 lakh 50 plus the basic exemption limit is 2 lakh 50. So on 12 lakh, you will consider your tax payable. So on that, you will apply your slab rate and determine the tax payable, which comes to 1,79,400. And on that, 50% penalty is 89,700. Are we clear? Can you see the answer? So on 12 lakhs, you will apply the basic exemption limit and the tax rates accordingly, which will come to 179,400 and 50% of that is 89,700. Last question. XYZ is a firm liable to tax at 30%. The following are the particulars furnished by the firm. As per the return of income furnished under 139(1), 50 lakh, determined under 143(1), 60 lakh, assessed under 143(3), 75 lakh, and reassessed under 147, 95 lakh. Determine the penalty. So what will be the answer? Yes, Kaushiki, that's correct. But partially. Okay, let's try and understand. First is determined under 143(1)(a). So 60 lakh and 143(3) 75 lakh. So there is under reporting of 15 lakh. On that, you will calculate the 30%, right? Tax which is there. How will you calculate? First, 15 lakh plus the total income of 60 lakh on that. So on 75 lakh, first you will calculate 30%. I'll show you the answer. Less tax on 60 lakhs, which is 30% plus 4%. The difference of this is 4,68,000. Penalty at 50%, which is 2,34,000. In the second case, it is 75 lakh and 95 lakh. Again, there is under reporting. So 25 lakh is the, 20 lakh is the under reporting. On this, again, you will consider like this, 20 lakh plus 75 lakh. On 95 lakh, you will consider 30%. Then again 30% on 75 lakh. So the difference of this will give you the under tax on the underreported income, and the penalty will be 3,12,000. Is this clear? Yes, Jacob, correct. Okay. So we are done with 270A. Now the next penalty which is there is under section 271 AAC and AAB. Now what is that? This is the penalty on undisclosed income found during the search. So we have done search under 132, right? If the undisclosed income is found during the search, then the penalty is initiated under 271 AAB. So in cases where search has been initiated and if the undisclosed is admitted during the course of search in the statement which is furnished and the assessee explains the manner in which the income was derived, then in that particular case, the penalty which will be there is under 271 AAB is 30%. So where undisclosed income is admitted by assessee during search in statement and assessee explains the manner in which income was derived, manner in which income was derived, pays the tax and interest on the undisclosed income, pays tax and interest on undisclosed income, and furnishes the return for the previous year declaring the undisclosed income. Furnishes the return of income declaring the undisclosed income. The penalty will be 30% of the undisclosed income. So he furnishes the return of income declaring the undisclosed income on or before the due date of filing the return of income. Okay. So in that particular case, the 30% penalty is there. Else, this is case 1, where the assessee is admitting the income during the search in the statement and he explains the nature and the manner in which income was derived. pays the tax plus interest and furnishes it in the return of income. In other cases, it is 60%. In other cases, under section 271 AAB, it is 60% of the undisclosed income. Are we clear? Fine. So this is the penalty under section 271 AAB. What is the undisclosed income? Undisclosed income means any income which is represented by money, bullion, jewelry, valuable article, or any entry in the books of accounts which are found in the course of search under 132 which have not been recorded in the books of accounts or not disclosed to the income tax officer. Are we clear? Or any income which is represented by an entry in respect of an expense recorded in the books of accounts which is found to be false. Clear? So that is the undisclosed income. You can write it. Undisclosed income means income represented by money, bullion, jewelry, which is not recorded in the books of accounts or transactions or documents found in the search and not recorded in books of accounts or not disclosed to income tax officers or any expense, income represented by expense which is found to be false, recorded in books of accounts and found to be false. Okay. So, if the penalty is levied under 271 AAB, then penalty under 270A for misreporting, underreporting cannot be levied. Further, this penalty order can again be appealable before the Commissioner of Income Tax Appeal. Clear? Are we clear? The next one is penalty on the undisclosed income under 271 AAC. Penalty on undisclosed income under 271 AAC. Okay. Now, this is the penalty for what? This is on the undisclosed income which is there. Now, undisclosed income is provided in section 68 onward, right? So, this is the penalty on that undisclosed income. So, income which is determined or income referred to in 68, 69, 69A to 69D. So, 68, 69, 69A to 69D. 68 is for the cash credit. Unexplained cash credit. 69 is for unexplained investment. 69A is for unexplained money. 69B is for investment not fully disclosed in books of account. 69C is unexplained expense. And 69D is amount borrowed or repaid on hundi. Now first we'll understand these sections before we understand the penalty thereon. Right? So 68, which is there, is the unexplained cash credit. What does section 68 provides is that where the sum of money is credited in the books of accounts, any sum of money is credited in the books of accounts for which the assessee has no explanation about the nature and source of that particular credit, or explanation which is offered by him is not satisfactory in the opinion of AO, then that credit will be considered as the income of the assessee. So any creditor also which is coming to your credit side for which the assessee has no explanation about the nature and source thereof, or any loan which is there, which is taken by you, or any share application money which is there, that can be considered here under 68. So under cash credit, where assessee is not able to explain nature and source of credit. Okay. So share application money, share capital, share premium. In these cases also, it can be considered as the unexplained cash credit, especially in a company which is a closely held company. So this can be also considered as the unexplained credit or cash credit unless the person, if it's a resident shareholder, and if the assessee offers the nature and source of that particular amount credited to share capital, if the assessee offers the explanation about that, unless he does that, that would be considered as the unexplained cash credit. Are we clear? Clear? So that is 68. 69, which is there, is for the unexplained investments. So where in the financial year, the assessee has made investments which are not recorded in the books of accounts, and the assessee offers no explanation about the nature and source of the investments, or the explanation is not to the satisfaction of AO, then the income of that unexplained investments or the value of investments will be deemed to be the income of the assessee. Similarly, 69A is there, where the assessee is found to be the owner of money, bullion, jewelry, or valuable article, and such money, bullion, jewelry, or valuable article is not recorded in the books of accounts, and the assessee is unable to explain the nature and source of it, then that is considered, the value of that is considered as the income of the assessee. 69B is the investments which a assessee has, and the assessing officer finds that the amount which is paid for the investments, for acquiring these investments, exceeds the amount recorded in the books of account, and that the assessee is not able to explain that how the excess amount is there, then in that case, that excess will be considered as the income of the assessee. Under 69C, where the assessee has any expenditure incurred and he offers no explanation about the source of expenditure, that will be considered as income of the assessee. So, unable to explain source of expense. This is regarding investment or money or bullion or jewelry recorded at price less than the amount paid. This is for the money bullion, jewelry not recorded. And assessee unable to explain nature and source. Similarly, this is for investment. Okay. Now, in all these cases, the tax which is there is levied under 115 BBE. The taxability is under section 115 BBE, which is 60% plus surcharge of 25% plus cess of 4%. So this effective tax rate is 78%. This is the tax under 115 BBE. And the penalty which is levied is under 271 AAC. The penalty is 10% of tax payable. Under section 115 BBE. Okay. So the penalty in this case will be 10% where the income includes any income determined under 68 to 69D. Now, in this case, there are two things. Where the assessee voluntarily discloses the income. Voluntarily discloses the income in return of income filed under section 139. Right? And the tax has been paid under 115 BBE on or before the end of the previous year. Tax paid under section 115 BBE. Then the penalty will not be levied. So no penalty in that case. No penalty under section 271 AAC. Clear? An undisclosed income, if it is not disclosed in the return of income, then in that case, there will be penalty under section 271 AAC at the rate of 10% on tax payable 115 BBE. Are we clear? Clear? And there will not be any penalty under 270A. If this undisclosed income is found during search, then there will be penalty under 271 AAB. So, this is if not found during search. If undisclosed income found during search, then 271 AAB. Clear? Then 271 AAB. Clear? Are we clear about this? Okay. Next important penalty which we have to do is penalty in respect of the cash transaction. Penalty in respect of the cash transaction. Now, this is the penalty under section which is there under 269 SS and 269 ST. Now, what is this? Let's try and understand. First, we'll understand these particular provision, 269 SS and 269 ST. What are these particular provisions? So let's try and understand. 269 SS provision which is there and 269T which is there, these are the two important provisions which are there to curb the cash transaction. Now what these provisions? First, 269 SS provide. 269 SS which is there is in respect of accepting loans, deposits and the advance for immovable property. So this is in respect of loans, deposits or advance for immovable property. Right? If it is greater than or equal to 20 lakh, this is accepting if greater than equal to 20,000, sorry. Otherwise, then by account paid check, draft, ECS or electronic mode. Otherwise, then for account paid check, draft, ECS or electronic mode. So any person accepting loan, deposit or the sum for the transfer of immovable property, then if it is exceeding 20,000 and it is otherwise then by account paid check, bank draft, ECS or through the electronic mode, then in that particular case, there will be the penalty under section 271D. Penalty under section 271D, which is sum equal to the loan or deposit or sum on transfer of property. Sum equal to loan, deposit or sum on transfer of property. Similarly, we have 269T, which is repayment of loan or deposit or advance received for immovable property. Right? So if it is, sorry, if it is greater than 20,000 and if it is paid otherwise then by account paid check or account paid draft or ECS or electronic mode, right? Then in that particular case, it will be considered as violation, and in that case, there will be penalty under section 271E. Penalty under section 271E, which is the same. Sum equal to loan, deposit or sum on the money transfer. Now this penalty is to be imposed only by JCIT. To be imposed by JCIT. Are we clear? So this is the penalty under section 271D and 271E. These are the two penalties which are there, which are to be imposed only by JCIT. Now, one particular circular which is there in the context of 271D and 271E. Whether the limitation for penalty proceedings under 271D and 271E, what is the limitation period? So we saw the limitation, time limitation, which is there is provided under section 275, right? If the order is the subject matter of appeal, then in that particular case, it is before the expiry of the financial year in which the proceedings are pending, or 1 year from the end of the financial year, this order is received by PCID. And if it is revision, then it is 6 months, and in any other case, it is after the expiry of the financial year or 6 months from the end in which the action for initiating penalty is initiated. Now, what is the time limitation for 271D and 271E? So there's a CBDT circular to that effect. Delhi High Court in one of the ruling had considered this issue of whether the penalty, what will be the time limitation for the penalty under 271D and 271E. So this particular penalty which is there, the time limitation under section 275, which is for the other cases, this one, this expiry of financial year in which proceedings are completed, and 6 months from the end of the month in which penalty is initiated. This is the time limit which is there for the 271D and 271E. Okay, so you can write it here. Even for penalty under section 271D and 271E. Okay, so it will be the expiry of the financial year in which the proceedings are completed, or 6 months from the end of the month in which action is initiated. Clear? Then commencement of limitation period for penalty under 271D and 271E. In this particular case, there is the Kerala High Court ruling wherein it was observed that the question to be considered with regard to whether proceedings for levy of penalty are initiated with the passing of the order of the AO, or whether such proceedings are commenced with the issue of notice by the Joint Commissioner. From when do you take the limitation period? From when the AO passes the order, or when the JCID initiates the penalty proceedings? So the competent authority to levy penalty in 271D and 271E is the Joint Commissioner. Only Joint Commissioner can initiate the penalty proceedings under 271D and 271E and not the AO. Okay, so the assessment order is inconsequential. Assessment order becomes inconsequential, right? So CBDT has clarified that in this particular case, what will be the time limitation from when it will start? It will start from the JCIT order, because the AO will not issue the notice for this. The JCIT only will issue the penalty notice and will complete the proceedings within the time limitation under 275(1)(c). Are we clear? Any questions so far? Okay. Okay. Now, there are few case laws which are there as a part of your module. What are these cases? First one, is penalty under section 271D imposable for cash or cash loans or deposits received from the partners? So if the cash deposits are accepted from the partners, will penalty under section 271D will be levied? So there are courts which have held that if the money is exchanged between the partners and the firm, since the firm is not a separate legal entity, 269SS will not be applicable. However, Delhi High Court in one of the cases had held that in this particular case, the source of money is not doubted because the source is coming from the partner. The transaction is bona fide. The creditworthiness of the partners, the genuineness of the transaction is clearly there, right? So in this particular case, penalty under 271D cannot be invoked because there is a reasonable cause which is shown that this transaction is between the partner and the firm. And therefore, 271D cannot be applied to the cash deposits received from the partners. Second decision is of Bombay High Court, wherein the question before the court was whether the assessee who repays the loan by passing the adjustment entry in the books, can that adjustment entry be considered as contravening the provisions of 269T and attract the penalty under 271T? So in this case, the assessee has not paid the loan otherwise than by account paid check. He has just made the adjustment entry. He has set off the amount payable and receivable by way of passing the journal entries. And the balance amount was paid by account paid check. Now, if the amount of loan which is exceeding 20,000 by way of passing the journal entry, then in that case, whether 269T can be attracted, that's the question. So Bombay High Court in this case answered in this manner. Then Bombay High Court understood that the assessee did this because it had the amount payable, it had the amount receivable. And therefore it set off the amount payable and the receivable by way of passing the journal entries. Now this journal entry amount exceeds by 20,000. Right? In this case, why did the assessee do so? Because it would have been stupidity to give the amount and take back the equivalent amount. Here, the genuineness of the transaction was not doubted. So, there was nothing which was suggesting that this is unaccounted money. And 269T technically does not make a distinction between the bona fide or non-bona fide transaction. It merely puts the condition that the loan or deposit, if it is repaid other than by account paid check, if it is exceeding 20,000, 269T will be applicable, whether it's a genuine or non-genuine transaction. Now, the assessee has contravened the provisions of 269T by passing the journal entry. And therefore, penalty is leviable under 271E. This is what court answered. However, the transaction was bona fide nature and the reasonable cause was shown. Therefore, because of the reasonable cause, the penalty will not be initiated. Are we clear? So, if the reasonable cause is shown, the penalty will not be initiated. Third case. Can the penalty, which is there, can it be initiated if the reasonable cause is not shown? The answer to that is no. So, the court specifically held that the penalty will be initiated. But here, since the reasonable cause was shown, therefore, the penalty was deleted. Are we clear? Okay. Now, the next particular penalty, what we have to do is, after 269 ST is 269 SU. What is this now? Section 269 SU. Now, this particular section requires that acceptance of payment only through prescribed electronic mode. Payment through prescribed electronic mode. This is applicable to person whose total turnover exceeds 50 crores. Applicable to person whose total turnover exceeds rupees 50 crore in immediately preceding financial year. Then, if the these prescribed electronic mode like RTGS, UPI, all of these are not maintained, there is a penalty under section 271 DB. And what is that? Rupees 5,000 per day. Again, this is to be imposed only by JCID. Okay. This is only to be imposed by JCID. Fine. Clear? Any doubts? Any doubts till now? Yes, 269 SS, 269T is applicable to all. Fine. Okay. So we have covered 270A, we have covered 271 AAB and 271 AAC. Now there is one more penalty which is under 271 AAD. What is that? This is with regard to the false entries in the books of accounts. False entry in the books of accounts or omission of an entry which is relevant for the computation of total income to evade the tax liability. Omission of entry to evade the tax. Now, false entry includes false or falsified or forged documents such as false invoice, right? This includes falsified documents or invoices. The invoice in respect of which, in respect of supply or receipt of services, are made without actual supply. Invoices without actual supply. Or invoices to a person who does not exist. Right? In this case, the penalty amount is sum equal to the amount of false entry. Sum equal to amount of false entry or omitted entry. Okay. So this is the penalty under section 271 AAD. Also, there is a prosecution in terms of if you evade the taxes. So if you evade the taxes, there will be the prosecution as well. Right? And the prosecution we saw was under 276C, right? Was under 271(6)(c). Also, falsification of books of accounts. Falsification of books of accounts to induce any person to evade tax. Again, for that also there is a prosecution under 277A. So it can be either under 276C prosecution, which is what we saw earlier, or if you induce other person to falsify, then 277A. To induce to falsify. And what is the prosecution? It is imprisonment of 3 months to 2 years. Imprisonment of 3 months to 2 years plus the fine. Okay. So there can be prosecution under 277A. Clear? Any doubt? Clear? Any questions? Any doubt? Okay. Now, after this, there are few more penalties which we have to cover, which is relating to 269. We have done it, right? Now we have to do some small penalties with respect to the normal provisions of the tax, right? And then the TDS, of course. Now, what are these penalties? Let's just do it very quickly. First is for the failure to maintain the books of accounts. Failure to maintain the books of accounts, the penalty which is there is, so failure to keep or maintain books of accounts or maintain or retain books of accounts under section 44A. Penalty is rupees 25,000. Penalty is rupees 25,000 under 270A. Under section 270A. Clear? Failure to get books of accounts audited. Failure to get books of accounts audited under 44AB. The penalty is 0.5% of total sales or turnover or gross receipts, or 1,50,000, 1.5 lakh, whichever is less. So this maybe you can also write it down where you have written 44A and 44AB, maintenance of accounts and tax audit. See, we have written it here already. Penalty was lesser of 0.5% of total sales, turnover, gross receipts, or 1.5 lakh. In case it is 44AA, which is maintenance of the books of accounts, for that the penalty is 25,000. Penalty under section 271A, 25,000. Okay. For the tax audit, we have already written. Clear? For transfer pricing, we will do it in the transfer pricing class itself, the penalty part for that. Okay. Now, next particular provision which needs to be covered is 269 SU. 269 SU, as I said, if it is not, you're not maintaining the electronic mode, the prescribed electronic mode for accepting the payment, then there is a penalty under that as well, which is what we already covered, which is 5,000 per day. Okay. Other than that, now we will have the TDS and TCS penalties which are there. So just write it down. Penalties in relation to TDS or TCS. Penalties in relation to TDS, TCS. Okay. Now, if there is default in payment of tax, if there is default in payment of tax, there is interest at the rate of 1% per month under section 220, right? So if there is default in payment of tax, then a notice of demand is raised under 220 for levying 1% per month interest if you do not pay within the 30 days, right? So then the 30-day period is given under 220. Then there is penalty under section 221 if there is default in making the payment of tax under 220. So the penalty is levied under 221. 221, the penalty as directed by the AO is levied if default in payment of tax under section 220. Are we clear? This is at the discretion of AO. Now, failure to deduct the TDS or TCS. Failure to deduct or pay the TDS, sorry, not TCS. Failure to deduct or pay the TDS. The penalty is under section 271C. The penalty is under section 271C. What is the penalty? The TDS amount. The TDS amount. This is levied by JCIT. So failure to deduct the tax or to pay the tax. In case it is TCS, that is under 271CA. So failure to collect tax or pay the tax. Failure to collect the tax, which is under not pay, payment. For payment, we do not have under 271CA. If the TCS is not paid, there is no penalty. If the TDS is not paid, there is penalty under 271C. 271CA just provides if there is failure to collect the tax. There is no failure, there is no penalty for failure to pay the tax. Okay. Here also it is under 271CA, which is the TCS amount. And again, this is levied by the JCIB. Are we clear? This is levied by the JCIB. Now, understand one thing over here. There is the prosecution also if there is failure to pay the TDS or the TCS, and the prosecution is under 276B and BB. So, prosecution under section 276B, and for this is 276BB. What is the prosecution? Imprisonment of 3 months to 7 years and plus fine. Imprisonment of 3 months to 7 years plus fine. Are we clear? Then failure to furnish TDS or TCS statements. Failure to furnish TDS or TCS statements. Failure to furnish TDS or TCS statements. The penalty is provided under 271H. The penalty is provided under 271H. And what is the penalty? Penalty is under 271H. What is the penalty in relation to that? Under 271H, it is 10,000 to 1 lakh. 10,000 to 1 lakh. Failure to furnish TDS or TCS statements within the time limit. Okay. But penalty would not be levied if the person proves that the TDS along with the fee under 234E and interest is deposited to the credit of the central government. He had delivered the TDS TCS statements before the expiry of 1 year from the time prescribed for delivering the statement. In that case, the penalty will not be levied. If filed within 1 year, no penalty. So not to be levied if TDS or TCS deposited along with interest and fees under section 234E and filed within 1 year. Okay. In case there is incorrect statement, then also this is the same penalty. So if incorrect statements are furnished, then also there is penalty under section 271H. Okay. Failure to furnish information or inaccurate information under form 15 CA-CB. So failure to furnish information or incorrect information under form 15 CA. This is for the foreign remittance, where TDS is under 195. Then it is 1 lakh rupees. Penalty is under section 271I and this is 1 lakh. Okay. Furnishing of incorrect reports by the CA. Furnishing of incorrect reports by CA. Let's say 15 CB audit report. Reports by CAs. It is 10,000 per certificate. Per certificate. Okay. Are we clear? Then penalty for the research association, university, college or institutions which have failed to deliver the statement of donations. Which have failed to deliver the statement of donations under 80G or under 35, then it is 10,000 to 1 lakh. Penalty for institutions or trust which have failed to deliver statement of donations under section 80G or 35, 10K to 1 lakh. Okay. Then we had already done penalty for the notices reply. We had seen that what was the penalty for failure to comply with the notices or failure to sign the statements made or refuse to answer the income tax authority or non-compliance with summons, failure to comply with notice under 142(1), 143(2) notice or 142(2)(a. It was 10,000. That we have already done, right? Isn't it? Fine. So that we have already done. Failure to furnish the return of income or failure to furnish the return of income for the trust and all of that, the institutions, for that the penalty is 100 rupees per day. And failure to deliver the TDS TCS statement, again the penalty will be the 100 rupees per day. Okay. Fine. Any doubt till now? Any questions? Failure to comply with the provisions of PAN also we have seen, which is 10,000. Failure to intimate Aadhaar is 10,000. That also we have done it. Failure to quote PAN, Aadhaar, that also we have seen is 10,000. And failure to comply with the provisions of TAN is again 10,000. So maybe you can write it over here. Provisions of TAN not complied. It is rupees 10,000. Are we clear? Any doubt? Any questions? Any doubt? Further, you can write down failure to furnish the return of income. There could be prosecution. I think we have written it already in the return of income. isn't it? I think we had written it. Somewhere I remember. If you have not written it, maybe you can write it down now. Okay, we can write it here. Prosecution as well. For failure to furnish the return of income under 139 or 142(1) or 148 both, then it is if the evaded tax exceeds 25 lakh, then the prosecution is 6 months to 7 years plus fine. And in other cases, it is 3 months to 2 years plus fine. This is also there for failure to furnish the return of income for under 139(1) or 142(1) or 148. Fine. Or even the updated return. Or even the updated return. Okay. If the return of income is furnished or the updated return is furnished, right? And the total income, so if the return of income is furnished before the expiry of the assessment year or the updated return is furnished or the tax payable by a person on the total income is less than 10,000, then in that case, there is no prosecution. So if ROI is furnished within 1 year before the expiry of assessment year, or under section 139(8)(a), updated return is filed and tax is less than rupees 10,000, then no prosecution. Okay, then in that particular case, there will not be any prosecution. Clear? Any questions, any doubts so far? Fine. Any doubts? Okay. So we'll close here for today. And then we will continue with rest of the small portion of prosecution in the next class. So thank you so much. I don't think there are any doubts. Okay, there is one or more doubt. Is 269 SS or 269 ST will be attracted if repayment for transfer of movable property? No, it is for immovable property. But if yes, there is the repayment done for any other particular property also, then also 269 SS and ST will be attracted, any kind of repayment. Clear, Jacob? The remaining chapters which are pending now are the tax avoidance, tax evasion, all of that, and then the international tax part, Jacob. Okay. So thank you so much. See you in the next class.